P2P is a collaborator or in competition with the major banks? So who thinks it's a collaborator? And who thinks it's competition? Who's not sure and wants us to give them a view? Okay, cool. All right, so that's where we're at. Why don't we start with you, Peter? What's the, does everyone know what P2P lending is, by the way? Yeah, please. Okay, why don't you do that? Yeah.
Hello. So just so everyone understands what peer-to-peer lending is, effectively, most people understand what crowdfunding is. So crowdfunding is normally where you, the crowd, get shares in the business. Peer-to-peer lending is similar, but rather than getting shares, you're getting debt from a business. So the whole idea is ultimately or individuals. So the whole idea is that you, the crowd, are lending directly to individuals or businesses. That's basically what peer-to-peer lending is. Just to give you some idea of numbers, it started about 15 years ago, currently doing around about $50 billion a year, forecast to be close to $1 trillion over the next 5 years. That gives you an idea of scale, at least.
So, what problem? So why is there a problem in lending? Like, where did that come from?
So peer-to-peer itself was born pretty much out of the financial crisis back in 2008, when a lot of the banks basically drew back from effectively riskier type of lending and lending which basically ensured that the capital requirements were just too great. So you found initially that the peer-to-peers that came out actually were lending to individuals. So these are individuals that had large credit card debt, maybe they couldn't be consolidated. In the US, they had thin file or no file credit history. In the UK, basically the banks had no desire basically to lend to these people, or were lending, but lending very badly. And that's where it all started from. And the same is true with SME lending, basically. The first SME lender to do peer-to-peer was in the UK, FiNextCircle. That started around about 2008. It's now done about $6 billion of lending to SMEs. Again, literally born out of the fact that these were customers that either the banks didn't want to lend to or couldn't operationally efficiently lend to. This comes back to actually the comment we discussed earlier around operational efficiency. It's all around how you can make decisions to SMEs quickly, and speed actually is the most important thing. For peer-to-peer lending, if you look at the three things, it's speed, cost, and availability. And so in the UK, for example, it's more expensive to get debt from a peer-to-peer business, but you'll get it in 30 minutes. And that's the critical thing. It's about speed of access to money. And that's basically where peer-to-peer really cut its teeth. And that's where it comes back to your initial question about kind of like partnership with the banks. It's really, that's where things are moving to. It's a case of how peer-to-peer can show its technology, proven results can work with banks to enable them to do operational efficiency around lending.
Suresh, you've dealt with SMEs pretty much your entire working life.
Yes.
From your perspective, because you've worked with a lot of different banks in the UAE, from your perspective, could you add some additional light to what Peter said? Is this true? Is this the current reality on the ground? What's the pain point of SMEs?
Sure. So absolutely right. Even in UAE, there are so many SMEs here, over 150,000, 200,000 SMEs, and it is difficult to get finance for SMEs for various reasons, right? And definitely peer-to-peer lending, we consider this as in personal opinion would be they are not competitors, they are collaborators. It helps, but what would sort of really take it to the next level would be, if you look at lending in UAE or banking in UAE has come a long way from what it used to be in the past, where everything used to be manual. There was no bureau. There was no VAT was just introduced a few years back, right? 2 years back was when VAT was introduced. I think now the country is in the right time frame that you have all these data points where, let's say, in peer-to-peer, you got two parties, right? There is somebody who is lending money, and there is somebody who's taking money. So the person who's lending money, the lender, he needs to have all these data, right, in a right format to sort of take a very calculated decision. Now, if data can be given to this person, let's say, what's the length of the business of this company, how much is the real sales, what sort of VAT they're paying, what is the sort of bureau credit history of this company. I think decision making can be really fast and really easy. And while we compare UAE with the let's say London or any other much more advanced countries, over there things are much more way ahead in terms of, let's say, your credit history is very well tracked. While in this country, just few years back, let's say 4 or 5 years back, one business could have put up an application for borrowing to, let's say, 5 different banks. And at one point in time, all 5 banks could have lent money to that individual entity. And just imagine the amount of cash that business gets, at one point in time. So today this cannot happen, because if one bank is lending, automatically the other banks get to know what is the exposure on that entity and at an entity level. So things are much better as compared to what it used to be, what they were in the past. And I'm sure from here, it looks like more and more such players coming into the market. I mean, things are only going to get better.
So I don't believe in sugarcoating things. I believe that if we really want to maximize or optimize operations and optimize the opportunities, we need to identify and be very, very clear on what the problems really are. I believe, for instance, and in your, gentlemen, you're in a far better position to tell me if I'm way off base, I believe there's lack of quality in companies to actually lend to, and lack of due diligence. I mean, one of my concerns about peer-to-peer platforms is who's responsible for the due diligence. So some interesting data that came out of CB Insights. CB Insights is a phenomenal research platform in the States, and they're particularly focused on startups. I know we're talking about SMEs, but it gives you some insight into the due diligence piece. So 70% of tech startups fail in the first 20 months, and they would have raised an average of $1.3 million. 70%. When it comes to those that raise money on crowdfunding platforms, the failure rate is 95%. So how do we make sure, because it's one thing to lend, and we need to make sure that we get money back. You're not
comparing apples with apples, that's the problem. So what you're comparing with is startups on an equity phase through a crowdfunding platform with debt
let me clarify the question then. I'm talking about it's one thing to have the technology in place, it's another thing to have the process in place to make sure that we're doing the proper due diligence on companies to make sure that we're not going to have bad debts. Bad debts and bad kind of financial structures led to the mortgage-backed security complete crisis. So we need to learn from our mistakes. So that's where I'm coming from a philosophical perspective. I know I can't compare SMEs to startups or equity to lending.
Shall I take that? So effectively, I think there are 2 valid points here. So one is what you classify, and I think it's also important to realise that peer-to-peer isn't just SMEs. Okay, so here in the region it is just SME lending. Okay, globally, it's more about lending to individuals actually than lending to SMEs. But bringing it back to the region, the very fact that everyone's aware that SMEs can't get enough cash, it's a government thing. I mean, it's nothing new. I came to the region over 10 years ago, and I remember over 10 years ago the talk was about SMEs not getting finance, and lo and behold, here we are 10 years later, and I think exactly the same message is coming out constantly, basically. Same's true in Saudi, same's true in Kuwait, same's true in Bahrain, so it's a GCC regional, Egypt, Jordan, etc. So I think what the platform, the responsibility of a platform is to basically set certain criteria around its default rate and its lending. Ultimately, the whole idea behind lending is that you, the crowd, or whoever the investor is, ultimately takes risk for losses. It's as simple as that. We are not regulated as a bank. We are not allowed to take regulatory risk. We'd love to, but we're not allowed to. So in reality, the way we prove our worth is by the very low default rates which we have. And the same is true for Lending Club in the US or FiNextCircle in the UK. If you look at the returns net of bad debt and NPLs, you'll basically be beating what you can get if you put the money in the bank. So our NPL rate is 1.5% after 5 years. That's significantly lower. 1.5% to SMEs unsecured lending as well. Yeah?
Unheard of.
Most banks here would kill for a rate that is 5 or 6%, that sort of size. Yeah, so it's a very strong position. That basically speaks the volume about the level of DD we do in our businesses.
I'm going to come back to that because it's one thing I think that sets you apart from a lot of the other platforms, and I know that's one of your concerns as well. So I'll come back to that. Ankur, I know you're itching to give us kind of your your tech view of this. So there's the opportunity, there's the challenge, there's the opportunity, and how do you see technology playing a role? And I know that you're also very good at recognizing what can be tackled with technology and what's linked to the human condition. Could you walk us through this?
So thanks a lot, Deborah, for that. So if you look at it over the last a decade or 2 decades, what has changed this whole financial system or our economies at large is about the tech enablement. We have seen some of the revolutionary technologies taking place, and which has allowed us to completely change the business at the core. Now, if I look at the peer-to-peer lending for that matter as well, it's a brilliant vehicle to provide the kind of the money to the SMEs and to the other, even for the individuals that matter, as Peter was talking about into the larger context. We need to be very sure about what is the due diligence that is happening. So let's again take a step back and think through it. Why in the first place we require these platforms to exist? So there has been some history, there has been the reasons why the banks has not been able to serve out those funding requirements for this. To Nikhil's point today in the morning, while he was talking about the loan processing maybe for those big banks might not justify the operating cost. That's the reason this is the significant pie which is getting unserved by the traditional banks or the financing institutes. But still at the same point in time, I would say when we talk about the technology taking place out there, how are models going to work? I think in last 2 hours or so, we discussed about how the AI ML is going to serve out. And we have seen that. So be it tracking your transaction history, be it figuring out what is going to be the credit risk involved while lending out the money. We need to be very sure whether this has tested over the period of time. The generation has changed. The economies is changing very fast. So if you look at if you are serving out a lending need of a Gen X versus Gen Y versus Gen Z, the dynamics are going to be very different. Now we are talking or living in the world of Airbnb and Uber, where you cannot check the credit risk based on what the user is possessing. He might not be owning the car anymore. He might not be owning the lot of property. So those things are going to fundamentally change. Are our quants models good enough to support that level of creditworthiness? The quant models of 1970s are not going to work in 2020. So I think that's where we need to be very, very sure about.
Interesting. Very, very good point. The three of you, what excites you about this space, and I think we've touched upon due diligence kind of being a worry for all of us, because you're only as good as your weakest link, right? And unfortunately, if one bad actor does something dumb, whether you like it or not, it infects everybody else. So what excites you about the space? What do you think the challenges are? And I'm going to then put out a call to action and set a gauntlet for the audience to take up on unblocking those challenges, because I can. Let's start with you, Suresh.
Sure. So what excites banks, in terms of, let's say, lending to SMEs or doing banking with SMEs? The first thing is they're obviously available in masses. Absolutely, they give you the best returns, right? What Peter said is 1.5% as a net credit loss. Even if this number would be, let's say, double, right? Still, it makes a case for lending to businesses, right? Your risk is very well diversified. And the best thing is you are partnering with somebody, and many of these SMEs eventually will become the mid-corporates of future, and very few of them will become eventually the large corporates, let's say, the large entities of, in the future. And if you partner with these businesses right in advance, right in the beginning stage, right, you're going to be their bankers for the rest of their lives. Many of our old clients who are mature SMEs, the M category, they just don't want to leave us because, we were the first bank or the first people to support them when they really needed support. So that's one exciting bit. It's a very dynamic, business environment. While these are the good parts, the challenge always remains the high cost of credit, which is, in good cases, it could be 3%. In bad years, it could be even up to, let's say, 4, 5, 6% also, right, if your lending is not very prudent. The other challenge in this business is, the cost of compliance, because from a regulatory point of view, from a compliance point of view, you got to be very, very watchful, right? So these are the two key areas, two key challenges, and in the whole model. I mean, the psyche has to be SME. You got to think like an entrepreneur. You got to think like a startup. even while working in a bank, when you want to do business with say, customers, who are, typically from the SME segment.
We say that, but in reality, how prevalent is that mindset in the big institutions?
Well, big ones, I cannot comment, but I can tell you what where I work and the way we operate. Absolutely, we work like entrepreneurs.
Okay, so let's put this to the test. So if anyone is an SME or a startup and wants to, and then give me feedback as to how we're ranking on this. Because it's, we're all in this together, right? It's an ecosystem. Absolutely. You're so cool. Thank you so much. Ankur, what excites you about the space, and what opportunities do you see, and what challenges, hurdles?
Sure. So the opportunity is huge if we look at it. So as we talked about, the pie is too big. There is a need for this parallel lending mechanisms to be available. If I see from a big mainstream traditional banking system, I definitely see a huge opportunity for a forward integration in the coming years, where when this whole space gets utilized, it's just going to get integrated well within the traditional banking system. So that way, it is going to coexist within the whole ecosystem of be it the big traditional banks versus the FinTech. And it's the line is just blurring out. If over the last 10 years, what I have seen, because of this whole change, it has just blurred the whole piece about what is only going to be the space that the FinTech is going to operate versus what is going to be operated by the big banks. So I think that is going to predominantly change the space part. What worries me is how we are going to transition over this journey. I think, yes, Peter shared some really good insights about how this has been proven over the last 10 to 15 years into the UK and US. So yes, we need to just make sure that while we take it to the main league, still we are talking about, say, $50 billion. It's a small number if we look at it. Yeah, but $1 trillion is something that, okay, that will start getting into the serious business. We need to make sure that from 50 to $1 trillion, we do all the right things. We build up the ecosystem that works well. The challenge that comes in over there is the regulatory part. That Suresh also touched upon that. Yes, we need to have a very clear, consistent view about how the regulatory space is going to go on this whole of the new ecosystem that we have to build it out.
Interesting, because regulation is playing catch up. So I think the thinking of the leadership, of the founders and the heads of the different businesses and the CEOs have got to be preempting, they've got to be designing businesses and partnerships where regulation needs to be. So they need to be super ethical, super moral, and think of where the trend is going to go in terms of consumer sentiment, right? Maybe I'll bring up data privacy again, maybe I won't. Peter, what excites you about the space? What opportunities and what challenges, what hurdles are there?
So if I just pick up quickly on the regulation side. So my view on regulation is a bit actually the regulate. I think. So when we launched in the UAE, we were unregulated. If you look at what went on in the UK, so FiNextCircle were unregulated up until around about 2016, I think they were. By that point in time, they'd lent in the region of $4 billion. Yeah, so pretty big money, completely unregulated. Lending Club in the US had lent approximately 20 billion, I think the figure was, before they got regulated. So I actually don't think the regulation actually is that important. I think what we got regulated here in the region, we forced regulation basically. The reason we forced regulation was so that investors felt happier about basically using us as a platform, and basically we had a rubber stamp to say, yes, we're regulated, your money is safe with us. I don't think regulation actually is ultimately the end game. I think regulation needs to catch up. What excites me about this region, about peer-to-peer, and I think peer-to-peer has moved on dramatically. So peer-to-peer no longer is actually peer-to-peer. Around about 90% of all money going over peer-to-peer platforms is now institutional. It's hedge funds, pension funds, anything searching for yield. For this region, where the real advantage is using platforms such as ourselves as distribution channels for government-funded. Basically, government sits on huge amounts of funds. Government basically is constantly wanting those funds to go out to SMEs, and yet it has no distribution channel of getting that money to the SMEs. We are a very good distribution channel. Moreover, you could basically do this rather than just literally doing dollar for dollar. You go, do you know what we'll do is we'll give you a 100% guarantee or an 80% guarantee over every single loan that goes out. So actually, in reality, you're suddenly turning $1 into $10 by actually using the entire free market. Because basically, if you know that basically you're lending to an SME and you are 100% guaranteed, you'll only want maybe a 5% yield. And the chances are that of that 5% yield, only maybe, let's say, 1 in 10 go bad. So the government is suddenly, by a factor of 10, getting its money out into the market. That's where there's real excitement. The second bit, I think, of excitement is actually where you see peer-to-peer platforms adopting from being a true FinTech player into a tech fin. My definition of a tech fin is where you're a technology business supplying financial technology to a bank, and the bank then basically does the on-lending. That's how you get scale. And you can see that's worked, like someone like in Cabbage in the US, a very, very large peer-to-peer business, how it's basically worked with Scotiabank in Mexico and in Canada, how it's worked with ING in Spain, how Oak North out of the UK is basically white labeling its software to help other banks do SME lending. That is where the real scale is. So ultimately, you look at peer-to-peer platforms and you say they've cut their teeth on doing direct lending. Now how can you leverage that knowledge, that DNA, the expertise, the technology to do lending actually using scale of the bank to get to basically end customer? And that is, for me, I think is a real excitement for marketplace lending in general.
So future conversations take place between the three of you. I look forward to seeing the outcomes of that. I have to admit, I have a soft spot for Beehive. They're actually a very interesting model of how they were designed from the first place. One of the things that initially grabbed my attention is the fact that you brought Rick Pudner on board as your chairman. As many of you who are familiar with the UAE banking environment, Mr. Pudner is a phenomenal operator. He is an extraordinary leader, but also an extraordinary human being. And I think he's a blueprint of the types of people that we need to help the fledgling companies really build awesome companies that can thrive in the future, because then they're more credible when they're working with the big boys like the CBDs and the JPMorgans and bigger than that. Right. I'm going to open up the floor to the question. Does the audience have any questions? Yes, gentleman in the back, please.
My name is Farhad Karamali. I work with a company called Converse Global. One important thing, I love the discussion, and it triggered a lot of thoughts in my mind, especially the word when you said Airbnb and Uber, because that's also going to go through a radical transformation very soon, that entire part of it. My question was triggered by Mr. Suresh Lalwani, what you said, and this question, by the way, is open to everybody else as well. What I need to know is, are there any special products that you have on offer for the startups and the SMEs, considering that they are on the beginning of a journey? And if so, and I'm not speaking specifically of your bank, but any other experience that you have, and if so, in order to hedge that, is there also a possibility of working with other people who could provide the startups with the skills they need in order to understand how to take the business up? So, two questions. A, are there products that the banks in particular offer? And is there a possibility of partnering and working with other organizations that would help reduce the risk? Thank you very much.
Sure. So, two things, so let's split this into two parts, startups and SMEs. Right, banks, let's understand the notion very, very correctly. Banks are commercial organizations, right? These monies that we have are of the shareholders and the deposit holders. So lending to a startup is always a challenge, right? That I don't think will happen. But what will happen is there are a lot of things that these days banks are thinking about. How do you support the whole startup economy? Not just by funding them, because many startups don't need funding all the time, right? They need a lot of support. They need hand-holding. They need, let's say, to start off with a basic account, which is, let's say, doesn't cost you too much and gives you all the benefits and tools that you need to sort of have a bank on the go, right? Maybe, let's say, a mobile app or a good internet banking platform, or an ecosystem where, let's say, if a startup wants to needs a lawyer or needs a any kind of business-related service, it could get at a low price because the banks are in a better way, in a better position to sort of negotiate with the suppliers at a big, for a good discount, and then that could be passed on to the startup. So that's for the startups. For the SMEs are businesses which are small. I mean, I'm looking at the S part, right? Companies who've sort of broken even and they're at least 2 years old in business. There are lots of options available. You could do invoice discounting. You could take a standalone business loan. You could do a little bit of working capital. You could do capex funding. So there are a lot of things. You could do check discounting. You could do factoring. Let's say if you're selling to any of the big entities and you have an invoice which is accepted, that could be discounted for an SME. So there are lots of products available, and banks are, I fully agree with what Peter said, that 10 years back, this was a story that, nobody's lending to the SMEs. I know the amount of lending that we're doing every month. So last year, we've given away over $1 billion dirhams in the market in terms of lending. And the other market leaders in the industry are also doing some very serious business, and the complaint still remains that, banks are not lending to the SMEs, right? So there are lots of options available for the SMEs, and there are many providers these days who can fund to the SMEs.
Anyone else want to add?
I think I would just say that we have to strike the right balance between the interest for the investors and to the lenders both. I think with the peer-to-peer lending, we are providing a technology solution. With the blockchain and everything, yes, you can even provide a collateralized loan. On the top of that, I can just digitize the whole of your collateral, put it onto the escrow account, as soon and put a smart contract on it. Once you are done with the contractual obligations, the money your collateral would be released out. All this is great. We just need to be very sure where is that thin line that lies. We should not be skewed on either side. That's where the next 5 years would definitely define that how effectively we can grow this whole area.
But also, if businesses buy products from an SME or from any company, they need to pay their bills, right? That would be a good start. Is that a fair comment?
Yeah, I think obviously the major problem here is the fact that big corporates don't pay SMEs on time. It's a fact. And I think the thing which I find very difficult here is you have some large government entities not paying on time. You have some large international entities who suddenly think just because they're in the region that they can adopt local practices, and suddenly in the US they'd be paying on 30 days as that's what the invoice says, but here it's totally fine to pay on 180 days because that's just practice. I think that's pretty disgusting, if I'm honest. There is the issue is around working capital, and that's where I think most SMEs struggle. And the point is it is S's I'm talking about here. I mean, M's will struggle as well. The figures are much bigger, but S's in particular, where we've seen businesses go under or really struggle, it's not because the business is doing badly. It's got good revenue. It's because it can't convert that revenue into cash, and this could be. You pick a big business here in the UAE, they're the people who are bad at paying at the moment. We had one who was with one of the big property developers, one of the better property developers here as well. Basically the business went in, it already paid, its terms were 30 days, the business was already paying 90, they renegotiated to basically take a 15% hit for basically being paid after 90 days rather than 30 days. Another 60 days later, so 150 days now, the developer still had not paid, at which point in time the business went under and 20 people lost their jobs. That basically is how, on a knife edge, a lot of particularly the small SMEs are operating. It's because basically the conversion from sale to revenue just doesn't happen fast enough.
Thanks for that.
Yeah.
Does that answer your question, sir? Yes.
Hi, I'm Mirhan Mandoor from DigiTeam, and I have a question regarding the due diligence that you mentioned, because that's always the challenge with, how much time does the bank spend to evaluate the creditworthiness of kind of an SME as opposed to like a large corporate, and you don't want to spend too much time and money on that. And you mentioned that the credit bureaus now are helping with this, the credit bureau. But what other technology are you using? So we spoke of due diligence and technology as well. So how can we leverage technology to probably facilitate that due diligence? And how do you track your teams to make sure that they're doing that due diligence properly on a regular basis? And perhaps for Beehive as well, do you use any kind of rating system for the companies that are on your platform?
Yes, so if I answer that one. So basically, so what you'll find is that in the UK, the US, the West, you have good established credit bureaus which you can rely on, basically. The credit bureau here for businesses is still pretty nascent. You'll find that sometimes there's a credit score, sometimes there's not. You certainly cannot rely on it 100%. For individuals, it's pretty much there, but for corporate, it's not. Interestingly, you compare and contrast that, for example, with someone like Saudi. SIMA, which is the regulator, so the credit bureau in Saudi, is very, very good because it's had a lot more data. So I think if you roll this forward 5 years, the credit bureau here will be very strong. It's just a case of it hasn't had the time to mature. Therefore, it's critical that you take data from other points. So we take most of our data from bank statements, actually. That's a critical bit. Nikhil was speaking earlier about how his business basically takes on and scrapes bank statements. We basically do the same, but we just do it through CSV file dump. So with that ability, you're looking at, let's say, potentially 6, 7, 10,000 different data points. Just literally looking at the bank statements themselves, and you can basically instantaneously, like by putting the data in, you can instantaneously flag away where there are risks and concerns out of the bank statements. So bank statements is one. We take management accounts, we take audited accounts, but as I'm sure the gentlemen here on this panel will agree, you can't rely on audited accounts. A, they can be fraudulent. B, even if they're properly done, they're probably going to be at least 10 months out of date. Therefore, and the business will change an awful lot in that 10 months. So the importance is actually where you draw those data from. So we draw data from bank statements, we draw data from management accounts, we look at debtor ledgers, coming back to my point on working capital, that's critical basically, and creditor ledgers as well. So also, not only how quickly you're receiving the cash, how quickly you're paying your debtors as well, suppliers. The other critical bit, which hasn't really been discussed here, is actually SMEs, particularly at the smaller end, are inextricably linked with their shareholder or their owner. So in reality, when you're lending to a business, you actually aren't just lending to the business, you're lending to the owner as well. So therefore, what our scorecard, and we have digital scorecard effectively, takes into account is around about 30% of the score goes actually to the owner themselves. Because basically, if you're lending to a business, the business looks great, but behind the business it's a shareholder, and that shareholder is financially stressed, that generally implies you've got an issue. Equally, skip history here is critical. You know, a single person renting a place on the Palm who wants to borrow 500,000 dirhams but has only been here for a few years is a much higher skip risk than someone who's been here for 10 years, is married, owns a house, there's equity in the house, got 3 kids in school. Yeah? They're not going to jump on a plane for 500,000 dirhams. So there's also other data points you pull in above and beyond what the SME is the owner as well. So we take all those data points. Come back to your question specifically around, do we have a critical scoring system? Yes, we do. And we have a full digital trail. So we can credit assess in 60 minutes. So that includes data ingestion to data output. And that data output and the data inputs we'll take, we believe, are in excess of what a bank would take to do the same work. But we can do that in 1 hour. And that's basically where it comes down to operational efficiency, of the ability to make loans at a smaller value, much more granular, but ultimately, operationally, still make it profitable for us to do them at that level of work.
Anyone else want to chime in? You're okay. Does that answer your question, Marhan?
Hi, my name is Shari. I'm going to wait for the verdict whether they're going to be collaborative or cooperative. But nevertheless, I do feel B2B as part of the space of commercial lending. So this question is to you, Mr. Suresh. What are the chances that a commercial bank would embrace this technology and offer that as part of your services? Do you think that's happening?
Absolutely, it's happening. Banks are super excited to get to sort of participate with fintechs, and we're always looking for new ideas. In fact, every 2 weeks, we have sort of a discussion with a new idea or a new vendor who is willing, who's coming up with sort of similar thought processes. For example, banks so things have changed, like what Peter has mentioned. So everybody has to go through this sort of due diligence process, wherein you're not just checking the business, you're looking into bank statements. And now things have, why, it gives me a little bit of hope is because, I come from a very old sort of a banking background where all these things used to be manual, and it used to take a month to assess a single case, right? And now when let's say a P2P lending can happen, let's say in 1 hour's time of assessment, banks can have crashed it down from 1 month to, let's say, a couple of days. So we're talking days now instead of months. So all this has been possible because of the good technologies or the good way of, let's say, the bureau scores being available, bureau report being available digitally. Then you've got bank statements now can be pulled out from a central bank system available digitally. So somebody doesn't need to, the element of fraud is out of it. So you're not relying on any individual to give you sort of some statements which could have been cooked up at home or in the office. But you get statements direct from the source. Then so there are good things in place now, and it's up to the banks or individual banks who will want to take the advantage of all the good things that are available and come up with the fastest model. Definitely, we are all excited and wanting to do, because again it brings in operational efficiency because the client is the same, right? So it really helps, and we are definitely onto it. You will see some good stuff coming up.
If I just jump in, so next month we are launching in Saudi in association with a bank. Yeah, so literally it's been taken us over 1.5 years to get to this point, but next month we will be launching in Saudi in association with a bank. So basically, literally the bank's front end, we are ultimately its digital front end for SME lending. Yeah,
that's a beautiful mix of
so that
technologies with the banking customer.
Precisely, and actually the model is even better than that because it also brings in the liquidity pools primarily driven from a governmental source as well. So this goes back to this three-legged stool of a bank having the regulatory oversight, ultimately wanting to get SME space, a technology provider such as ourselves who knows what we do, SME lending, and then a third source, which is ultimately is government funds wanting to get to the SMEs. So it's a perfect symbiotic relationship. So that proves that banks here are wanting to talk to tech businesses about doing this sort of stuff.
Thank you so much.
Congratulations on that. That's awesome news. One last question.
Good evening. My name is Urvisha and I'm from PitchBooks, India. We have been helping a lot of startup companies since the past few years globally, raise funds from various investors. My question is, there are a lot of challenges faced in India, especially because when their first preference of these startup companies is to be funded by venture capitals or private equities. Probably because they feel being backed by a VC would give them more credibility. So what would these funding platforms provide in terms of confidence building or value addition to these startups in India?
So, your point is spot on. If you've got a VC behind you, then actually that does give you a whole lot of additional kudos for equity financing. I think the equity crowdfunding platforms play a vital role, and you'll see that equity platforms globally, the amount of cash raised exceeded angels for the first time, I think it was 2 years ago, and it's about to exceed VC and PE probably this year. So that shows you the growth of the platforms. Equity platforms bring a different side to what a VC can bring. So equity actually, particularly for a customer-facing or consumer-facing product, is very good. You can get fantastic PR about it. Look in the UK, there's a business called Nutmeg, which is a FinTech actually, helps basically individuals do saving. The majority of its money it raised, and it's a very, very, it's worth more than £1 billion, yeah? So it's very highly valued. The majority of that money has come from VC, PE, etc., PE now in particular. But it also did a crowdfunding slice purely from a marketing and PR perspective, because basically the free marketing that Nutmeg got out of doing that marketing, that's a slice for the crowdfunding piece, was basically free marketing. It's great. So I think you find that the equity crowdfunding platforms can give additional pieces. Also, I mean, VCs generally not that interested in pure startup. It starts basically at like the next stage. And actually, sometimes an equity crowdfunding platform can basically help lots of businesses start from the very, very initial stage, i.e. that first $50,000, $100,000 before basically the VCs then come in at the next stage.
I'm going to put a fly, I agree with you, and there's a fly in the ointment. How much money a startup raised is not a sign of success. The fact that they have customers that pay their bills, I think would be much better. I think there's a lot of hype in the market, and I think there's going to be rationalization, inshallah, because, yeah, I mean, last year I saw a lot of bonds. So yeah, just had to put that in, because there was an opportunity. Any closing comments you'd like to before we're kicked off the stage? If there's one thing people in the audience can do to be part of the ecosystem and proliferate this, what should they do from your perspectives? Pay SMEs on time.
Become an investor on Beehive.
Are you allowed to do that?
Of course I am. It's free PR.
Ankur.
I think just take a broader view of it and look at it from a longer perspective. I think that's only the one thing that I would like to say.
Great.
I think, SME is the spirit of entrepreneurship, and we must make sure that it continues. Right? Either it is to pay SMEs on time, or to give them orders, or whatever it is. Because if Dubai used to have a very high spirit of entrepreneurship. I mean, I used to meet businesses back in the day. So if you meet the owner and then you meet his manager would always want to aspire to become like his owner. Someday set up my own business, have my own shop, or have my own restaurant, or whatever. That spirit has gone down a little bit these days.
And
for
also,
whatever reasons.
they're the job creators as well.
They are the job creators.
That's an important piece
so
to
it's
remember.
important that the bills of SMEs are paid, and in the first place, let it be accepted so that banks could discount them.
Fantastic. Gentlemen.